We begin this first session of our series with the theme Macro Outlook and Review of Industry Metals. Before discussing individual metals, it is essential to understand the global policy and demand supply forces shaping the entire metals ecosystem. With this, I am pleased to invite our co-founder, Mr. G. Chandra Shekhar to share his perspective on how macroeconomic trends, infrastructure spending, and policy direction could influence copper demand in India over the next year. Over to you, Mr. Chandrasekharji.
Now, let me very quickly let us review what happened until 2025, until last year. I call this decade, the decade of the 2020s, a disruptive decade. We have seen in 2021, COVID, pandemic, your lockdown, etc., etc. 22, 23, 24, two wars happening simultaneously, Ukraine, Russia, and then, of course, Israel, Hamas, etc. And as if all this was not enough, one Mr. Trump came into the White House and the whole of 25, we had tariff-related challenges. And in the meanwhile, inflation was at elevated levels, interest rates were high. Of course, they are now tapering very, very gradually. Therefore, the tariffs have currently created. And over the last 15 days, there is so much more that is happening. Venezuela, Iran, you name it, and all that's happening. And therefore, this has created enormous geoeconomic uncertainty and geopolitical instability. And over the last 4 or 5 years, again, the result of all of this disruptive decade that I call is sanctions, protectionism, resource nationalism. Particularly, I must single out Indonesia for that. Supply chain disruption, all of us are aware of this. Huge price volatility, market uncertainty, and most important, in my view, investment uncertainty. Investors are extremely cautious, actually reluctant to invest money in say, mining, exploration, or manufacturing activity. And that can potentially have a long-term impact. But that be that as it may, we today live in what I call a VUCA world: volatility, uncertainty, complexity, and ambiguity. And we cannot wish this away. We have got to learn to become resilient. Now, if I were to talk about a quick review of industrial metals last year, as we all know, the metals market posted very strong gains. LME index was up more than 20% from the beginning of 25 till the end of 25, more than 20% gain, and it reached the highest level since March 2022. But the contribution of each metal in this uplift of the index has been very, very different. As we all know, primarily it was copper and aluminium which actually drove the index up, and there are solid reasons why they did. 2026 key themes. Very clearly, my own as an economist, I believe the global macro outlook is optimistic. There are many people saying cautious optimism, which I think probably describes the sentiment better. Cautious optimism is the main theme for 2026. Again, when you look at the developments, geopolitical risks appear easing currently, or they seem to be less threatening, put it that way. Let us ignore what happened in the first 15 days of this year. If you keep that aside, I think the geopolitical risk is much less threatening now than it was, say, probably 6 months ago. But they will likely stay at fairly elevated levels. Similarly, US tariff risks have abated substantially because US has signed trade deals with many countries. And therefore, they will abate, in my view, the risks will abate even further as we go along, go into 2026. The fiscal policy, in my view, again, around the world, and particularly in the US, Europe, China, and other emerging economies, will remain very substantially supportive for growth. And the US Fed, I'm sure, We'll have a very moderate rate cut. We've already had 3 rate cuts in 2025. Don't expect multiple rate cuts, at least in the first 6 months of the year. I can't see a rate cut coming, notwithstanding the pressure on the Fed. It may happen one cut between April and June, that is the second quarter, but certainly not before that. And the others will follow the path that Fed lays, other central bankers around the world. Liquidity conditions are expected to very substantially improve. They'll become more favorable with slight reduction in interest rate and inflation not staying elevated but actually declining. Liquidity conditions will become favorable. My view, as far as the dollar is concerned, it is likely to post modest gains. There is no doubt at all. It is not going to weaken further, whereas it would possibly gain strength vis-a-vis the euro and other currencies. Something in addition, key themes for 2026. The US, they call this economic exceptionalism. I expect the US's economic exceptionalism will continue into 2026. After all, the US is the world's largest economy, $25 trillion, and its military might, its technological prowess, all of that is well known. They will continue to contribute exceptionally to global growth, and it will continue to remain strong. I also won't be surprised if there is a new global order. I am already seeing incipient signals of this new emerging global order because of the tariffs imposed by President Trump and the new trade deals that he has signed with so many countries, including many of the Asian economies, Japan, South Korea, Vietnam, etc., etc. There is a possibility of a new global order. China, on the other hand, world's second largest economy, close to $20 trillion in GDP terms, is actually pushing to boost its manufacturing activity, particularly high-tech manufacturing activity, which will create, again, domestic or internal demand within China for a whole range of critical minerals. But that's another conversation. But what is important for industrial metals is that China is curbing its overcapacity to start with in steel, of course, and it set a new limit on steel metals production. 10 ferrous metals have been identified for reduction in their production by 1.5% per year over the next few years. I think we discussed this in one of the events in 2025, probably 3 or 4 months ago. I can't recall. Very important crude oil market. Crude oil, after all, is a universal intermediate. Crude oil prices impact cost of production, inflation, etc. That market is going to be oversupplied in 2026. Prices are most likely to decline well below $60 a barrel. Brent, I'm talking about, although in the last 10, 12 days, there are geopolitical stresses, which is keeping prices above $60. But once this normalizes, in my view, Brent should fall well below $60 a barrel. Most important, again, is energy transition. This energy transition is very substantially metals intensive, and that the progression in energy transition across the world is going to accelerate, which will obviously create a more demand for a wide range of metals. Many economists believe the global GDP growth should be just hovering around 3% in 2026, with China possibly recording 4.5% growth, and the US possibly recording slightly above 2% growth in 2026. One known unknown is something I want to flag here: artificial intelligence. AI, as all of us know, is exerting pervasive influence across industries, across the economy, and on the mankind really speaking in some way. I don't know, and many people are wondering, like me, many people are wondering, will AI be a shock absorber? The world is going through so many shocks, geo-economic shock, geopolitical shock. Will it become a shock absorber, or will it become a shock magnifier? Will it lead to large scale unemployment, etc.? Is AI a bubble? We don't know. So whether it's a shock absorber or a shock magnifier, only time will tell. But one small consolation that one can derive is that there are companies called hyperscalers, companies like Nvidia, etc. They are called hyperscalers, and their balance sheets are quite strong. If AI were to be a bubble, I don't think their balance sheets would be as strong as they are currently. So possibly the benefits of AI are going to be real, and the world will enjoy the benefits. I think it's in this backdrop that we need to examine the dynamics and the drivers of the industrial metals market, particularly going into the first half of 2026. I'm seeing when you look at all of this, my own sense, I get a sense that the global metals market is entering a new era. China, as we all know, over the last 25, 30 years, was virtually a single driver of the global metals market. As they say, if China sneezes, the world metals market catches cold. China is a mover and shaker of the global metals market. All of that we have heard. So China was the most significant mover and shaker of the global metals market, and the entire metals trajectory was driven by China. I think that is now changing. That is, I won't say it's coming to an end, but it's certainly changing, because the next phase of metals growth is not likely to be driven by any single growth engine like China. Okay, or there was only one simple macro narrative in the last 25, 30 years: track China and you've tracked the world metals market. But that kind of single narrative may not hold true anymore, is what my sense is. On the other hand, I'm seeing very clearly what is emerging is a global marketplace which is more fragmented, which is more policy driven, and which is geopolitically charged. I think this is something all the players, the value chain participants in the metals market will have to realize. There is a paradigm shift in the way the metals market is going to work over the next several years. Now, I was asked to speak specifically. Beena Bain called and said I should talk about demand and where will demand come from, etc. Demand, yes, there will be demand, but the drivers of demand will become are a lot more diverse now than they were in the last 10 or 15 or 20 years. China, yes, will continue to remain as a key consumer, but as I said earlier, they are not going to be the dominant, or they are not going to be the dominant force as far as industrial metals are concerned. My sense is that demand is going to be sector specific, and that demand will be driven by and shaped by a few sectors. One is electrification, second is clean energy, third is defense spending, fourth is data infrastructure. And I see defense spending extremely important, primarily because of what is happening around the world these days, the wars, etc. Tension between China and Taiwan, China and Japan, your Thailand, Cambodia, India, Pakistan, you name it. There's so much of stress and tension. Therefore, defense spending is certainly going to increase, and of course, the data centers and data infrastructure mushrooming across the world, and all that's going to take up a lot of industrial metals and of course energy. But this is going to be uneven. It will be geographically concentrated. It will be driven by favorable policies, and this development, the demand will be sensitive to technology choices and regulation. There is absolutely no doubt at all. Even you look now, look at it now. There are some metals which are leading the rally. Those are the metals which are critical for electrification worldwide. For electrification, e-mobility, I think that's going to be the theme for 26 and even beyond. While talking about demand, we also have to look at supply. My view again, 2026, supply is going to be less elastic. So we have a very potent combination of diverse demand, but supply is going to be less elastic. Usually markets respond to high prices with high supplies. But in case of industrial metals, I'm seeing in 2026, the supply response to rising prices is going to be rather slow. And it's going to be slow primarily because for long years, this sector is underinvested. The ore grades are declining, and as we all know, and of course the gestation period is also increasing, and all this is worsened by environment concerns, regulatory constraints, and of course the social challenges, etc. Further, from a supply perspective, you have resource nationalism. We know China, we know what Indonesia is doing. Export controls, yes, of course, critical minerals by China. Stockpiling, Europe is beginning to stockpile critical minerals. I'll just come to that a little later. And all these are going to disrupt established supply chains, and therefore the market tightness, market is tight, will get tighter, and that tightness, in my view, will persist for longer periods of time. That will spur price spikes, that will lead to higher price volatility. And this is a situation of tight supplies will attract a lot of speculative capital into the market, into the derivatives market in particular, which can again exaggerate the price impact. And therefore, our friends here, the value chain participants, have to be very careful. Therefore, and then geopolitics, that's going to take the center stage. And because geopolitics is going to further disturb the metals market and result in supply chain risk, countries and corporates, I'm seeing clearly, and they're also advised, I'm advising them that reduce your over dependence on a single source of supply, reduce your over dependence on a single destination market, diversify your sources of supply, diversify your market, build your reserves. That is becoming the norm worldwide. And that example I want to share here, the RE Resort EU Action Plan is something which has now come very recently, that aims to stockpile raw materials, secure materials vital for their green tech and defense. That is Critical Raw Material Act, CRMA, Critical Raw Material Act. And when a country decides to stockpile, it is usually it doesn't care for prices. It is price insensitive. Whatever be the price, I've decided to stockpile, and therefore they will build their inventory. The other one which I want to flag, I'm sure many of our friends may be aware of this, is the European Union's carbon border adjustment mechanism. I think again we discussed this in one of the events sometime last year, which wants to advance sustainability, decarbonization. It wants to encourage import of metals with low carbon emission, etc. And therefore, all that can potentially impact global trade, import, export trade. But to start with, I think steel and aluminium are on the radar of the European Union. Therefore, in sum, there is a new metals market playbook globally. Okay, therefore, this metals cycle over 2026 and even beyond will be fundamentally different from what we saw in the past. The new cycle will be shaped by diversified demand sources and will be driven substantially by electrification, defense, and digital infrastructure. Supply responses will be slower, and that will be further constrained and will be politicized. Is a big risk that the market has to face. There will be much higher levels of volatility because of geopolitics, and of course our move towards decarbonization, and of course the growing role of stockpiling and defense spending is something we cannot, no one has any control. Therefore, my friends here, I want to mention, I have no stake in business, but I want to share my thoughts that you need to understand these drivers. These drivers will be central to navigating the metals market in 2026 and beyond. Some of them we have no control over, some we may have some control. We need to look at what are those risk management principles and policies that we need to follow. Give me 2 minutes, Binaben. I'll just this is the last part on copper, because our theme is copper. Sorry, I'm getting carried away by what I'm speaking, but please allow me, bear with me. Okay, so copper, as we all know, best performing industrial metal in 2025, sharpest price rise, 42%, new high recently touched $13,000, mind-boggling. The main driver is not so much the current physical mismatch between supply and demand. It is a concern that the supply in the coming days will not be able to keep up with rising demand. Demand growth will be faster than supply growth. And the long-term optimistic demand outlook is boosted by, obviously, advances we are making, rapid advances in electromobility, expansion of data centers, and increased use of AI, etc., etc. At the same time, production is threatening to fall behind. And we said earlier. But my sense is that, yes, production may fall behind, but there will be some supply response to prices. ऐसा नहीं कि कोई supply response होगा ही नहीं है. I'm already seeing proposals and implementation of projects. These high prices are seen driving investment in both brownfield and greenfield projects across the world. 2 years ago, I think all of us talked about copper touching $15,000 price by 2030. I was one of them. I'm actually now going to advance that target date by 2 or 3 years. It could be 27, possibly, that it will touch 15,000. It can happen 2 or 3 years earlier than 2030. The fear of US extending this tariff beyond semi-finished product to refined copper is what is driving prices up because of uncertainty. US companies are building stocks, but as of now, there is no clarity. So when this announcement will come. At the same time, China's production, I am seeing those numbers month on month is going to remain strong in the short term, but H2, second half, will bring some clarity. I won't be surprised if production plateaus in the second half. And therefore, because Chinese production is strong, is there a potential for a price correction in the short term in the coming weeks? I don't know. I'm not giving any price forecast or outlook, but I won't be surprised if there is a small correction from the current 12,800 or whatever that price level is. And with this, I think I should bring my presentation to a close. I'm open to receiving and answering questions. Disclaimer, I'm bound to give the disclaimer. I'm not a trader. I don't hold any trading position. I'm a student of the market, and I'm coming from that perspective. Thank you very much. Good luck. God bless you all. Thank you.